Hello and welcome to the brand new episode of ET Markets Smart Talk. I'm Tanya Aneja, and today I'm going to be joined by a very special guest. We have with us Mr. Dhaval Kapadia, Director, Managed Portfolios at Morningstar Investment Advisor India. Thank you so much, Mr. Kapadia, for joining us on ET Markets.
Yeah, pleasure to be here.
So let's start with the current market scenario only. The war is still on. Inflation has not come down. FIIs are still selling. Rupee trading at record low. Rate hikes are happening. So how are you approaching markets at this point in time?
Yeah, it's like, if you were to think of it, it's like the perfect storm, right? You've got so many factors in a way coming together, right?
Absolutely.
But just talking about how we are approaching this, right? And if I were to take a step back and just talk just very quickly about our the way we view these kind of scenarios, or not just these scenarios, but markets in general. So essentially, our investment process in a way focuses on two main areas, right? So one is trying to understand the fundamentals or assess the fundamentals of an asset class, right? So for instance, if it's equity markets, if it's debt markets, or any other asset class or market, what is the sort of underlying value of that asset class, right? Which is typically based on expected earnings or expected growth in cash flows and earnings and so on and so forth, right? That is one area. The second area that we tend to focus on is the price that you're paying for that value. In other words, the valuations of that particular asset class or that particular security, right? So that's the way we try and view, asset classes as such. And the way we are seeing things today is obviously clearly, the impact of some of the factors that you mentioned. I mean, whether it's inflation, high commodity prices, rising interest rates, and so on and so forth. We think these factors are would definitely have an impact on corporate revenue growth, corporate earnings, and profitability, right? But that might be more over the near term. So maybe over the next few quarters is where we see probably this impact will be greater in that sense, right? So, but if you're a long-term investor like we are, we tend to be, a long-term investor. If we look through, say, over the next, 3, 5, 7 years, we think probably the impact of these factors would tend to sort of reduce in that sense. So from from an underlying value point of view, from if I'm looking at, say, equities as Indian equities as an asset class, right? I mean, we are not revising downwards our long-term growth expectations. So long-term growth expectations remain as they are. Maybe over the near term, and this is what we've been concerned as well over the last, not just over the last few months, but maybe over the last couple of quarters, that earnings growth expectations were very high. A lot of people were expecting earnings growth and profitability to continue to grow or grow very strongly over the next couple of years. So probably that may come down a bit, right? So, but like I said, long-term growth expectations still remain there. In terms of valuations, we think although the markets have corrected, so valuations have reduced a bit. They were in the expensive zone maybe earlier this year as well, but right now they've probably come off a bit, but they're still not looking very attractive. So in other words, Indian equities, particularly small caps and large caps, are not looking very attractive as such. They're close to maybe slightly above fair value. We think mid caps have seen a fair bit of fall as well. We think those are looking slightly better as compared to large caps and small caps in that sense. So that's how we are thinking of markets at this point of time.
Okay, absolutely. And now let's come to the strategies now. I mean, what should investors do to protect their portfolios, and how should they navigate this kind of market and manage risk?
I would think the key, the mantra, it may seem like something that you heard very often, but it still works, right? I think the key is asset allocation, right? I mean, decide, how much to invest in each asset class based on your risk appetite, based on your investment horizon. I think those are the key drivers, right? I mean, if you've got a near-term goal, say you need money to buy a house or for some other purpose over the next, couple of quarters or something of that sort, then, your portfolio will need to be conservatively, positioned. So your allocation to equities will need to be lower, irrespective of where the markets are, right? So Therefore, I would think, that is very important to maintain across market cycles. At times people lose track of that, right? When an asset class is doing very well, like we saw equities do very well from, say, the latter part of 2020 till, early part of this year. And, a lot of people get excited by it, right? Why do you, and the allocation to equity in most portfolios would have gone up, right? So, and the key thing is to review it and rebalance it from time to time, and not, get overexcited by a particular asset class's, performance in that sense. So I would say asset allocation, maintaining it close to, what your target levels are based on, like I said, your investment horizon and risk appetite. The second part would be is to review and rebalance on an ongoing basis, right? I would say it doesn't need to be every day or every month, definitely not. Probably every 6 to 12 months. I think, uh, seeing where you stand right now in your portfolio versus your target allocation to, say, equity, debt, international equity, and so on. So I think, that is important to maintain. The third thing that I would mention is diversifying your portfolio, right? And at times, and again, people lose sight of this time and again, right? I mean, they tend to see which asset class is doing very well, which funds are doing very well, and jump into those, all out at times, and taking heavy concentration. Like we've seen a lot of people, buy into the big tech companies in the US, right? So those NASDAQ funds and the, those kind of technology kind of funds and so on and so forth. Even Indian IT has done very well over the last couple of years, and people were, probably continuously adding on to their positions there. I would think one has to be a little bit cautious about concentrating their portfolio too much in a particular sector or a theme, and diversifying it across, I would say, Indian equity, international equity, and fixed income. And in fact, just for international equity, just to add, I mean, I would think that in times like these, when the rupee is depreciating, right? I mean, those kind of asset classes will tend to do well because they benefit from rupee depreciation. So I think that also, in a way, brings to, I would say, gives more emphasis to diversifying one's portfolio. So I would say, just to summarize, asset allocation, regular review and rebalancing and monitoring, diversifying the portfolio, and not concentrating too much in specific themes or sectors as such.
Absolutely. Very well explained, Mr. Kapadia. And what if someone is planning to put, let's say, 10 lakh rupees right now, which is the ideal medium according to you?
So when you say medium, you're referring to, how should they construct their portfolio?
Absolutely,
or what should you? And again, I would go back to the same thing which I mentioned earlier, that it would depend on, your horizon and your risk appetite. So that is one thing that we discussed already, right? So I would say, create a diversified kind of a portfolio based on your risk appetite and your horizon. And the second thing I would say is probably one can stagger their investments rather than go all out. Even if you've got a 10 lakh rupee to invest at this point of time, instead of putting it at one go, although we've seen the markets correct, but probably, markets will continue to be volatile for some time now. So there could be better opportunities coming through. So maybe stagger the investment to maybe over the next about 6 to 9 months or so. And if you see a sharp fall in the markets, maybe you can, reduce the time period of your STP or something of that sort. So I think, again, asset allocation as well as, I would say a staggered way of investing is the way I would think.
Okay, staggered way of investing. That's the word coming in. And also, how do you position your debt portfolio in a rising interest rate cycle?
Yeah, absolutely. And of course, rising interest rates, I think, it has obviously its positives and negatives. One is, you start to earn better yields or better coupons on your, debt holdings as such, because, the yields on those debt funds will tend to go up, right? I mean, but of course, if you're in the midst of rising interest rates, prices of bonds tend to come down. So that has a negative impact on the value of your, debt holdings as such. So the way we are seeing, debt investments right now is that if you look at, different parts of the bond market. So there are a couple of ways to look at this, and I'll just put it in a very nice or short way in that sense. So one is based on duration or maturity. Okay. So you have short-term sort of segment of the bond market, like which is a 1 to 3 year kind of segment. You have the 4 to 7 year, which is a medium term, and then you have the longer term segment of the debt market as such. So I would think probably the way we are seeing things is that the medium end of the debt market looks attractive. right? The reason for that is the additional spread that you're getting for holding, say, a 5 or 6 year kind of security or a bond is much higher than what it is to be historically. So just to give some context to that is that if I were to compare the yield on say 5 to 6 year kind of government securities versus say a 3 month treasury bill, the spread, the additional return that I get is about 2% odd, right? And which we think is looking quite attractive. So I would think that probably an investor can sort of have say a I would say split the allocation between short term and medium and long term. So maybe a short term debt funds or short term bond funds can comprise about say 30 to 40% of the debt portion of the portfolio. Maybe 20 about 30 odd% can be medium end, and the remaining can be at the longer end of the yield curve. No, so that's how I would position the debt portfolio. Obviously, the other way to sort of also look at is whether you should invest in corporate bonds or government securities and things like that. So I think probably government securities or funds that are investing in government securities are looking probably slightly more attractive. For instance, I mentioned the medium end of the 4 to 7 year kind of segment. So one could look at target maturity funds which are investing in 5 to 6 year kind of government bonds, and we think that probably looks fairly attractive at this point of time.
Absolutely. And also, Mr. Kapadia, the first half has been brutal for the equity markets. So which are the factors that will play a major role in the second half, according to you? And where are the markets headed basically in the near term?
In terms of factors, I think obviously, the Federal Reserve and several central banks, including the RBI, have been, talking of raising interest rates. Some of them have already happened, right? But I think that would continue into the second half. Okay. Also, of course, the slowdown in economies will also start to play out probably. I think that's what, the central banks are targeting, is to cool down. Obviously, their main goal is to cool down inflation. But how do they cool down inflation is by trying to slow down the growth, right? So the demand and the strong growth that you've seen. So probably some of that will start to show up in the second half of the year.
Okay.
I think another factor which probably is starting to play out now is that because of concerns of slowing growth in some developed countries such as the US, there is a concern of recession as well, right? Where economic growth could turn negative. Right, so some of that is started to play out on commodity prices. So commodity prices, which has been an area of concern, some of them have been coming off over the last month or so. So you look at crude oil prices, you look at other industrial metals, they've come off by 8, 10, 12% or so over the last month. So I think some of that will also play out. So in other words, what could start to happen maybe in the later part of the year is that inflation actually starts to come down. Okay. So that then becomes in a way positive for markets in that sense. These concerns that we are seeing right now, maybe later in the year or early next year, you could see some of these concerns start to sort of come down as we go ahead.
Absolutely. And lastly, before we let you go, your advice for all the new and young investors, any mistakes that they should avoid at this point in time?
I think the key thing is to avoid chasing trends and fads, right? I mean, we are seeing that play out in the crypto space right now, right? We are seeing, whether you call it as a meltdown or whatever else. I mean, you're seeing a lot of investors probably are burning their, have burned their hands in that kind of space. So I would say be very careful of chasing, fads or trends that you see, suddenly everybody's talking about it and you feel, wow, this seems exciting and so on. You need to, if at all you want to take a position, maybe it could be a small portion of your portfolio. But I wouldn't go all out in chasing these kind of, trends and fads. So it can really hurt, one's portfolio in a bad way, which we're seeing right now. It's not just crypto, like I mentioned earlier as well. Certain other, so a lot of people look at, recent performance of different asset classes, different markets, and they tend to jump into markets that have done very well over the last couple of years, right? Or asset classes that have done very well. I mentioned earlier, say the IT sector or even the big tech companies in the US, right? I mean, they've done very well over the last, till the end of last year. They were doing very well, I would say over the last 4 or 5 years or so. And then a lot of people started putting money into those, sectors, into those stocks, and you've seen a sharp correction since then. So I would say be careful of chasing, probably stay away as much as possible from these, fads or short-term trends as such. So I would say probably that's the key to keep in mind as such.
Absolutely. On that note, Mr. Kapadia, thank you so much for sharing your thoughts and being with us here on ET Markets today. Thank you so much.